sharp gyrations in crude prices make it only harder for central banks to chart their rate trajectory. And Aramco is warning that it might take months to resume full operations at two of its facilities only makes it tougher. More so for a country like India, which remains one of the world's largest crude importers. So can it prompt the Monetary Policy Committee to reevaluate its position of being squarely focused on growth? Joining us now to talk about it is Upasna Bharadwaj, Senior Economist at Kotak Mahindra Bank. Upasna, thanks very much for taking out the time. This has thrown spanner in the works with regards to, us talking about inflation remaining benign and the RBI focusing on growth now. And if this actually lands up taking a lot more amount of time, which could lead to further crude oil price volatility, what does it do in terms of the thought process?
Yeah, of course, if we were to just keep this crude oil shock aside for the time being, then yes, we know that the growth slowdown has become fairly entrenched across sectors that we've been seeing. And of course, at the same time, we are seeing that the headline inflation is also remaining very benign, especially because of demand side pressures being very muted. We are seeing that the core inflation remains fairly contained. In this kind of a backdrop, until now, of course, crude oil prices were stable. So clearly there was, and there still exists a room for monetary accommodation. And I think we would continue to see that. But yes, with the recent events, the volatility has, increased significantly, and given the extreme, dependency of India on oil imports, oil prices, of course, the financial assets in India become, fairly intertwined with the moves in oil prices. Having said that, I think if we were to look at the sensitivity of oil, yes, inflation tends to pick up with a $10 move. By about 35 to 40 basis. We do see current account deficit also worsened, which was actually becoming fairly muted in this year because of much weaker imports that we were seeing. So we do see about a $10 move resulting in a $12 to $13 billion impact in current account deficit. Growth also gets a negative terms of trade shock, and we tend to see about 25-30 basis impact or adverse impact on growth as well. So yes, the fundamentals do get shaken if we were to see a sustained uptick in crude oil prices from these levels. Now the bigger question is whether this kind of a supply disruption will continue and hence put upside pressure on crude oil prices further from here. As long as, I would say $70, $71 is capped in terms of crude oil prices, I don't think it meaningfully changes the fundamentals of India to that extent, because that is the range which anyways we have been working with. But yes, like I mentioned, maybe globally a coordinated policy response, and that's what we're hearing from, that at least in the near term, to bridge this gap, sudden supply gap that has arisen because of the blast, we will be seeing a coordinated policy response, which will ensure that supply is still adequate. The inventory levels globally are still comfortable to manage about 60 to 90 days of demand. Yeah. And I think within the 60 to 90 days, we might see the Saudi Arabia's output gradually, normalize. So we do have time before this can really turn into an ugly event. Yeah. And I think that is why at this point in time, we would want to believe that it is not a permanent disruption. It is a temporary disruption, and we will start seeing oil prices normalize again, eventually slightly at lower levels, because somewhere demand is also slowing down. So the global slowdown, supply-demand balance will still be kind of restored to that extent.
All right. Upasna, so the August WPI inflation, remained flat, and that was also one of the reasons was the subdued fuel and power inflation. Now, obviously, with prices, if they start to harden from here on, fuel prices, how soon can they show up in the inflation, in the fuel price inflation? And therefore, when October comes, do you expect any change in the commentary of the Monetary Policy Committee?
So I think our in-house estimates suggest that there ideally with a $10 move in crude oil prices for the coming fortnight, probably 5 to 6 rupees is the increase in the retail level gasoline prices that we'll see, in the upcoming few days. I think, but that is something which we'll have to see how that really pans out, whether that pass-through really happens. So that is one thing, and clearly that will have a little bit of bearing. But the crude oil prices have already been subdued, and hence I think overall, given that the core inflation is in check, there will be a marginal uptick in one of the internals, but the headline still remains in check, and hence I don't see too much of a significant upside risk to inflation trajectory at this point in time. A persistent increase in that $10 crude oil prices will definitely translate into, like I said, in the next 3 to 5 months down the line, we would have seen an impact of about 30-40 basis. But having said that, for the October meeting, yes, the governor would be cautious, but I don't think that should change the course of monetary policy action at this point in time, because even if we look at 6 to 9 months down the line, the headline inflation still remains below 4%, except for 1 or 2 readings here and there which just touch and go 4%. Largely in the next 6 to 9 months, we're not looking at inflation above 4%. So if the crude oil prices were to sustain at least in the next 1 month, 1.5 months around 70, 65, 70 range, that also does not necessarily translate into a very high inflation number. At $65 a barrel, we would see a 30-35 basis impact if crude oil was to average around 75. So a $10 move is what I was talking about. Mm-hmm. So I'm not seeing too much of an upside risk in terms of CPI headline inflation. And given, like I said, that growth is extremely weak, my sense is we would continue to see monetary accommodation. We're looking at 40 basis of rate cut in October. WPI reading also just re-emphasized the fact that there's such low pricing power. CPI, of course, like I said, food inflation is slightly inching higher, but core inflation, which is the real demand side pressures, are still muted. All in all, yes, 3 to 4 months down the line, if crude oil prices sustain, we might see WPI inflation getting much faster. The transmission is faster in WPI than in CPI. But CPI also might start gradually reflecting that increase in the next 3 to 4 months.
All right.
But that depends on the sustainability of the crude oil prices above 70.
All right. So, you said you were expecting a 40 basis point cut in the October policy. We've got the Fed policy meet coming up. And while obviously the market has factored in a 25 basis point cut, there is a probability now starting to shift, about 34% probability of the Fed actually not doing anything. But the commentary definitely is expected to be less dovish. Keeping that in mind, obviously, all of these factors, will be taken into consideration when our monetary policy meet happens. So, in light of that, does 40 basis points look a little bit more to you excessive?
At this point in time, when there is, a shift of the global central banks towards further accommodation, and if not really getting into accommodation, but at least ready to act, that is the forward guidance that we're getting. And if you ask me, my sense is we may not necessarily see a rate cut by the Fed in this policy, but I think the guidance will still be that we are ready to act as and when required. Because the data in the US is relatively firm, and I still don't see that urgency for them to act in this policy. So I would assign a higher probability of a pause in this Fed meeting. But having said that, like I said, the forward guidance is going to be very crucial. And my sense is the forward guidance will relatively be dovish despite a pause in this meeting. And then if we were to put the ECB, the upcoming BOJ meeting, and all of the other key global central banks, I think the global slowdown and the consequent policy response will keep the global conditions benign, and hence provide room for India also to act accordingly. So I don't see it to be too aggressive. I think our GDP forecasts for this year are at 5.8% for the full year. Clearly there is a need for monetary accommodation. We know there's limited fiscal space, and hence I think at this point in time we see monetary accommodation to probably, at least be acting as one of the enablers, if not necessarily a big trigger for revival in growth.